Let's welcome on board our experts, Mohammad Hassan, head analyst, hedge funds at Eurekahedge. And we've also got on the show with us Michael Howell, the MD at CrossBorder Capital, joining in. Gentlemen, morning. Mohammad, if I could start the discussion with you, tell us how are the flows to emerging markets at large the last 2 weeks been? Are there clear signs of a slowing down? I mean, is the sell in May, go away phrase really coming out to be true?
Definitely a lot of tensions right now going on in the market, but what we are definitely seeing is that sentiment on the whole improved in the first part of 2019 compared to the lows we saw in 2019. And overall, on the hedge fund side, the AUM has expanded by close to 30 billion in 2019, but that's come mostly on the back of strong performance, and we are still tracking investor redemptions. But the slightly positive news is that the pace of these investor redemptions has slowed down a lot. So we have seen the investor redemption volume actually half compared to what we saw in Q4 of 2018. So it appears to be slowing down, and it appears that investor nerves are calming. But then, as we were all talking about, we've got another bombshell on the market in terms of the US-China trade war intensifying again. So it remains to be seen how this plays out for the rest of the year.
Michael, what's your take? We have seen that reversal of flows from EMs like India. Do you expect that to continue for some time?
I think what you're seeing is a strong revival in capital flows coming towards emerging markets that are very reminiscent of what happened in 2016 with what was then called the Shanghai Accord. Markets benefited from cross-border flows significantly.
Okay. We'll go back across to Michael in a moment. Mohammed, given that the trade war negotiations seem to be fairly extended, I mean, it doesn't look like we're going to have a clear resolution in sight. At the same time, we have had, China already act when it comes to the Treasury front. How much volatility are you really anticipating, and how would you, diverge those expectations between the equity and the bond markets?
I mean, it's definitely adding to the overall risk premium that investors are demanding, because we are seeing higher volatility levels across the board. And up until a couple of years back, central banks would generally raise their interest rates and try to calm investor nerves that way. But now, led by RBI, we are seeing a lot of central banks considering rate cuts because they fear that they need to meet their growth targets across the board. And in the case of India as well, we have seen the RBI cut rates twice this year. And they are also feeling a bit of pain because inflation is still coming in on the strong side. And with rising oil prices, there's more of a concern as to how they balance the competing needs between the interest or inflationary concerns versus trying to stimulate growth in the economy. So on our end, we would expect RBI for the moment to hold on, but perhaps towards the year end, we might be poised for another rate cut. But there should be more clarity once the election cycle results are out towards end of May.
Michael, just want to, get the discussion back with you. From the looks of it, the trade war is likely to be a very prolonged one. Do you expect this volatility then within equity markets and fund flows to stay?
Well, I think the volatility certainly will be around, but I think one of the things to remember here is that if you look at the flow of capital into emerging markets, there's very often a division between money flows going to China and money flows going to India. And generally speaking, India benefits when money is not going to China. A lot of investment managers globally tend to take a view where they balance the two economies. A strong China tends to detract from India, whereas a weak China or uncertainty about China will actually cause money to flow more towards India. Following the election, I think that the stability of the Indian economy has a lot of attractions for foreign money, and providing that currency markets remain stable, which is probably a reasonable assumption, capital flows can continue to move there.
Okay. Michael, one more question then. Do you think there is a sudden risk-off momentum in the sentiment with VIX across the globe rising?
Across global markets, that's really another question. That comes back to the stability at the heart of the system, which is really the US. We think that volatility is very much embedded in the system now. The way that the US financial system works means that there's always a risk of December-like events going back to December 2018, with a sharp fall in markets almost into a sort of crevasse-like feature. And that is something which is going to be with us, we think, for the medium term. However, that doesn't necessarily detract from my point about cross-border flows, because cross-border flows have been, over the last 2 to 3 years, quite depressed, but they're now starting to come back again. There's quite a lot of confidence or growing confidence in the world economy, and people are beginning to believe that world economic activity is at least stabilizing now. And against a background where the dollar is firm but not necessarily too strong, that should be a decent recovery or decent background for capital flows to emerging markets to continue to recover.
So, Mohammed, how are hedge funds, strategizing at this time? We've seen the VIX also surge, the global CBOE as well. What is the kind of positioning right now, especially on the EM front? Are funds looking at increasing cash levels? Do you see what kind of impact or what kind of meaningful impact are they really anticipating?
Well, for the most part, funds are, of course, looking quite cautiously at what's happening in the market right now. There are two clear big challenges right now in the market. One, like I mentioned, the U.S.-China trade war intensifying again. And the other one is basically what's happening geopolitically as well between the U.S. and Iran. So one probable consensus in the market is that because of all these macro shocks kind of lurking on the horizon, the Fed might either kind of stay put in terms of its rate hiking cycle, or maybe even decide to lower interest rates in order to stimulate the economy, which is one of the big bets that some hedge funds are looking at right now. And that's important because what we're essentially looking at is everything being shaped by the coming elections in 2020 in the U.S. And we must bear in mind that Trump has for a long time been asking the Fed to remain more accommodative in terms of the market. So in general, yes, funds are looking cautiously at what's happening in the market. They are trying to reduce their net long exposures. Some hedge funds, particularly the ones that we've been looking at in the Indian hedge fund space, they've also reported on the hedging costs being a drag on their portfolio returns. So the general atmosphere feel right now for a lot of hedge funds is to kind of wait and watch and see how this thing resolves itself.
Okay, fair enough. Michael, when one looks at the outflow, of the last 2 weeks, should one be looking at this as a reversal after 4 months of positive flows? Given that EM equities have already given up all the relative outperformance that investors were searching for, what happens? Does this lead to now exasperated outflows in the near term?
I don't think necessarily. I think one has to look at the background rather longer than maybe a few weeks or months. And if you look at what's going on in the global economy, the real factor that will be driving the world economy, and particularly the Asian economies, will be the momentum of the Chinese economy. China has been tightening monetary conditions for at least 6 months now. It's been doing that through the period of the US-China trade talks. That probably is a tactical and a defensive move to try and maintain stability in the yuan currency. That's something they've often done before. And the reason for that is quite simply that when the yuan weakens, it's something that the Chinese authorities are concerned about because it can tend to cascade. They lose control. So the tightness in monetary conditions in China is likely a defensive move for that. Once the China-US trade talks are out of the way, we would fully expect China to ease aggressively. It will probably have to do that because to give some more momentum to its economy. Once it eases, you will see a likely increase in cross-border capital flows coming into the Asian region. Now, as I said, if you look at the divisions of those flows, the amount of money actually going into the Chinese economy with the additional burden of tariffs or uncertainty maybe about the longer term trends in China in terms of the exports, etc., or whatever, We think more money will, at the margin, be allocated to India and some of the regional markets. The fact is that China may be the driver of the regional economies, but it isn't necessarily the best market to invest in. For that, one would have to go outside and look at some of the other markets that benefit from maybe Chinese supply chains or Chinese demand, or maybe indirectly the growth in the Asian region. So we're very positive about Asia. We believe that this backdrop is, or the backdrop which is uncertain at the moment, will basically move towards a more positive outcome on a medium-term view. China has to ease policy, and as China eases, it will drive the Asian economies much higher. And one has to remember the starting point, and the starting point has been one where for the last 6 months at least, China has been tightening monetary policy.
All right, fair enough. But, just finally, Michael, a recent survey of fund managers done by Bank of America Merrill Lynch says that investors are well hedged but not positioned for a complete breakdown. Would you concur, and could we expect a sharp correction if indeed talks do fail?
Well, I think that, as I said earlier on, I think markets are in a state where they are inherently volatile. That comes back to the structure of the global financial system. And you can see the reaction of markets really over the last few years since the financial crisis in 2008. They've basically moved, they've been highly sensitive to very small moves in economic data or in monetary policy shifts. So markets are very nervous. We have to understand that. But I think if you look through that and come back to the fundamentals, at the end of the day, fundamentals drive markets. And what you have is a backdrop, particularly in the Asian economies, where long-term growth prospects look, we think, compelling, where investors are still not participating fully in asset markets, in risk asset markets, and there's a lot of money on the sidelines which can potentially come in. So volatility in many ways is an opportunity. We believe that there are the preconditions for a long-term bear market are not there. Those long-term preconditions would likely rest on a rise in international inflation, and that doesn't seem to be an issue at the moment. And what you've got generally is fast growth economies in the Asian region, potentially fast growth economies. They will be underpinned by stimulus in the Chinese economy, from the Chinese economy, and that we think will guide more capital flows into these markets. I mean, after all, if you look at the choices globally, there are not many choices. Europe looks a complete disaster. America has already had a bull market, so it's really only Asia, which is the one remaining region where capital can flow to. And we're certainly assured that the Asian outlook on a medium-term view looks very good.
All right, gentlemen, thanks so much for joining us. Mohammad, Michael, both of you, and taking us through the latest there on flows and what can be expected in light of the current volatility.